Our David Faber's reporting the government, at least at this time, is unwilling to rescue First Republic. We just touched on that. So if the other banks, if they don't buy those bonds at a loss, what is the potential impact to those other banks? And also, what's the potential impact to consumers like us?
Well, for the other banks, it's not just, the FDIC, while it's backed fully by in the end, it's backstopped by taxpayers. The FDIC is funded through assessments of big banks. And so if First Republic fails, the FDIC could assess that cost to the whole banking sector, but the biggest banks pay the largest percentage of that. But the other issue the banks have is that they have 30 billion, at least 11 biggest banks. They have $30 billion in deposits at First Republic. So there's this calculus about whether, in the recent bank failures, the FDIC has backed all the deposits, but you could see that's one of the negotiating things, right, from the FDIC probably at this point saying, hey, if this fails, not only are we going to assess you, but you could be out your $30 billion in deposits too.
So potentially that hits the top and the bottom line of these other banks that put their money into First Republic. Is there any consumer impact to any of this happening?
The consumer impact would be if this sparks, more concerns. Like, say that the First Republic fails and, a certain portion of its deposits are not insured, then it starts to be a concern for other banks. And that drives up what those banks have to pay. And, we to try to keep deposits. And we see a kind of acceleration of this bank run.
So possibly a systemic risk here. Possibly.
Possibly. You have a lot of banks looking around their shoulders saying, who's in trouble and do I have counterparty risk? And that makes them nervous and makes consumers nervous, and potentially it slows down spending, although we haven't seen that yet.
All right, let me ask you, I guess, what's the $30 billion question? We saw other banks go out and they bought the majority of assets and some of the assets of Silicon Valley Bank and Signature Bank. Why is there so much deal hesitancy? It appears to be when it comes to this bank and its assets.
Well, I don't. So we don't quite have the timing right? Yes, Signature and Silicon Valley got bought, but that was only after they failed and there was a government backstop. Like those, I think the fact that the way those went in terms of like the buyers that got them, they got these loss sharing deals and they got carve outs for certain things they didn't want. Remember, Signature, the crypto assets stayed with the FDIC. And so the fact that they got such sweetheart deals, I think that means that other people who are looking at First Republic are sitting back and saying, hey, wait, I'm better off waiting till this thing fails and I'll get a better deal. And that's part of what's going on here. There's a chicken game being played by the government, by the big banks, by First Republic. The FDIC would lower the ratings, the camel ratings of the bank. That's what you're talking about, and remove its ability to borrow from the Fed discount window. All this is the game of chicken going on to see who blinks first. The banks want the best deal. The First Republic wants to stay in business. The government doesn't want to be seen as bailing out a bank. It's all this chicken game going.
Yeah, game of chicken in the financial sector. That doesn't sound great, Stephen Gandel from the Financial Times.